Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. Since the market entered May, it has shown some interesting patterns in their resultant moves. From mid-March, we've seen the formation of two patterns. Firstly, a reverse head and shoulders pattern. Secondly, an ascending triangle. The ascending triangle had been constructed in between the uptrend, currently at 1131, and a flattish trendline topside, currently 1152. Primary targets for both of these were reached on the 17th of May for an unusual key reversal up, which was also an indecisive spinning top, but with a long tail on it. I've now retired these targets, as well as the unobtainable secondary targets. Indeed, I said after these were reached, and I quote, "It very much looks like, at least for now, that prices have achieved what they needed on the upside. We're now seeing a move back down to gather ammunition." End of quote. Since this happened, I posed two questions. How far will the market fall, and will it possibly turn into a fully bearish move instead of just a pullback down? So there were originally four areas to look at for pullback. The very recent 50% Fibonacci line at 1166, the upper trend line stroke neckline of the ascending triangle stroke reverse head and shoulders pattern, currently 1151, the congestion area 1104 to 1125, that has the short medium moving average just below it, currently 1104, and finally what was at the time below all the previous supports, the lower trend line stroke uptrend of the ascending triangle, currently 1131. All these failed to stop the market's decline. However, they're now resistances. However, there was an additional area below this which turned out to be crucial. I said at the time, and I quote, "There was an additional area below these, the 50% Fibonacci line for 2022 at 1051. But I was reserving judgment on that back then. Any of those previous four areas could have halted the move lower and turned prices back up." End of quote. And I further added, and I quote again, "However, the last one being broken, the 50% Fibonacci line at 1051, could trigger the beginnings of a bearish incentive." End of quote. As I said, all four support areas are now resistances, and has been the last chance support saloon support, if you like, of the 50% Fibonacci line for 2022 at 1051 that has managed to hold up the market, including testing over the last 2 weeks, plus this week as well, and even today. So far it has held. So what is next? Well, there is some interesting action going on here. You see, overhead, we have the resistance of the flatlining short medium moving average, capping the market, helped by the Fibonacci and other base congestion zone between 1105 and 1125, plus the broken trend line of the ascending triangle, currently 1131. So those seem pretty good resistances. But what do we have as support or supports? Well, apart from the 50% Fibonacci line, we haven't had much below until recently. You see, we do have stratified supports, but they are significantly lower. They're at the following areas: 1016, 1003 to 999, and 959 to 978. Whilst we do have some specific levels in there that are quite interesting, it is worth looking at the support holistically as a big picture. You see, if these very stratified levels, it is these very stratified levels of support that eroded the fall back in March, grinding away at the move down like so much sandpaper, such that by April the market was ready to rise again. Now, I'm not saying that this may happen again automatically, but it is worth remembering. Then there's the joker in the pack. Coming into the frame these past 3 weeks, moving up swiftly, and we have the medium moving average, currently 1037. And that could be an interesting event when it meets the market. You see, it could very well either fortify the 50% Fibonacci line, quite well indeed, but it may also prompt a crisis event that may make this market take a move, maybe back up and even possibly down. I suspect that we will see prices exceed the 50% Fibonacci line at 1051 late next week, or early the week after, or I suspect that we'll see the medium moving average exceed the 50% Fibonacci line at 10:51 late next week or early the week after, given its recent rate of moves higher. And that's when we may have a crisis event. Watch this space. Chicago corn. First off, please kindly continue to ignore the color change on some of my labeling. This is something that my charting system occasionally does without my permission. There is no special quality attributed to the different colors. Okay, so the turnaround in the market in late April was caused by the rise from the March-based double bottom meeting its end. The rise peaked 7 weeks ago when the hubris of the market met its nemesis. The reason for the lack of further bullish action after such a bullish pattern can easily be seen, and one that I've spoken about some time before. To recap, it was the market running into the middle time overhead, currently 8.55, of the April 20 to September 2021 bullish Andrews pitchfork. You can see how this middle time had become like a rolling higher resistance back in early March, and then again at the end of April. The result of all this was a fall in prices almost all the way down to the lower time, currently at 693, of the same bullish Andrews pitchfork 2 weeks ago. On the move lower, prices broke down through the following supports. They are now resistances. The congestion at 789, the October 2012 high at 776, the November 2012 high at 768, the short medium moving average currently 762, and the February 2013 high at 747. Now, interestingly, as the market has moved higher, we've also seen some resistances have been overcome and reassert themselves as support. These are the May 2021 high at 735, the November 21 to February 22 broken bull channel line, currently 741. That's an interesting one, actually. The interesting medium moving average, always interesting, that one, 729 currently. The March 2013 high at 719, and the interesting 61.8% Fibonacci line of the September 21 to April 2020 move at 700 even. There's a lot of things to say, a lot of interesting things, but the most interesting thing here is with all these initial moves lower, the original April 20 to September 21 bullish Andrews pitchfork that started the whole move higher last year is still found to be very, very valid. Hence, despite the attempts lower, nothing has changed in the picture of this longer-term bullish pattern. All we have seen was a pullback down in an overall bullish scenario. One other final point. Just off the top of my daily chart is target X in the 890 area. This I drew back in March and is the target for the May 21 to date action being a rounded bottom pattern. I had highlighted this pattern back in March. Well, this target is still good. It's just, well, it's an awfully long way up from where we are now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright AD Tofpik and ADM Investors International Limited. And here comes the final bit.